Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm going to talk about how we all need to stop asking banks what velocity banking is. And we're also going to do a velocity banking review. So I've had several people talk to me and say, "Hey, I asked the bank what velocity banking is and how to do it." And to me, that's like the same thing as going to Home Depot and asking them how to build a house. Home Depot does not actually teach you how to use the tools that they sell, as far as I'm aware. I know they have those weekend community workshops. They just sell you the tools, right? And so it's the same thing with velocity banking. When we go to the bank, they just offer tools. It's our job to kind of just figure out how to most effectively use them, right? That's essentially what the bank is for. So when the bank, you ask the bank like, well, I'm trying to do this thing called velocity banking. Really, you should just be asking, do you offer lines of credit, or what kind of debt products do you offer, and then use the appropriate tool to do that, right? So, in order for us to do velocity banking, we only need two things, right? Number one is the budget, because our budget is kind of like our attack plan. And if we don't have any debt, we don't need to do velocity banking, because velocity banking is all about paying off debt, right? And so if we do our budget, we see four debts here, and every debt that we have is essentially a leak in our cash flow bucket, right? It's a leak in our cash flow bucket. And all the actual strategy is using a line of credit as your main tool, as your main operating account, and paying the debts off quickly, right? And so if you ask the bank, how do you do this? First of all, banks don't even train their employees, and I think it's actually to their advantage to not train them. And most companies in general don't train their employees, right? You ever been like to a health food store and people are eating Chick-fil-A? Sometimes like I see a cashier have like a Chick-fil-A soda drink in like a Sprouts Farmers Market. It's like, what are we doing, right? Nobody trains their employees, and frankly, most people just don't even care. It's all most there's no real training going on. So that's one reason why you will never hear about velocity banking from the banking job. In fact, I've actually heard people say they've done presentation to bank executives, and they're like, they had no idea what they're talking about, right? And it was like, I'm having my eyes wide open. That's what I've heard before. I've never done a presentation to a bank executive, but I've heard that before. Okay. Now, why is it that the bank employee or whoever is not going to know what you're talking about? It's because the implementation of the strategy is just using your line of credit as your main operating account. So all it is entire paycheck into line of credit, and then expenses out of line of credit. That's it. And so when you tell them this, like, I want to do velocity banking, that's going to make any sense, because that's your responsibility to implement the strategy, and they can't tell you like how you're going to use the product, right? Like, if you buy groceries at the grocery store and you're going to make food, right? You're the one who has to come up with the recipe. And the recipe, when it comes to velocity banking, the instructions are entire paycheck into the line of credit, expenses out. And all the bank is responsible for is selling you essentially the tools and debt products. Okay. So now we have our budget. Now what we're going to do is select our line of credit as our main operating account. And what is a line of credit? All it is a financial tool where you can borrow money, pay back, and use it over and over again. Oh my goodness. Right? We have something called a HELOC for that, home equity line of credit. And I remember when I first bought a home, after 3 months, I got a $15,000 home equity line of credit. And now I have a $50,000 one. And I think if I get a new one in about 6 months, then I should be able to get like 150,000. I don't know. I got a ton of equity. In fact, I only have two homes, but between those two homes, I have $370,000 of equity. And that's why real estate is pretty great, because you can build a lot of equity for essentially doing nothing. All right. So now we have a HELOC, home equity line of credit. Kind of think of it as a credit card based on the value of your home. And we're going to use that as our operating account. So that's essentially the only difference between um, this column of the average American and this column, which is velocity banking. And here's a crazy thing that we're going to do. We're going to have zero savings. See, society in general teaches us we got to have like a 3 to 6 months of savings or something like that. We're going to do the exact opposite. We're going to throw all our cash into our debt. And obviously, we want to be strategic about it. And so the most important thing is having the tool, having the income, and knowing which debts to pay off first and which ones to pay off last. In general, we always pay the mortgage last. In fact, I've never seen an exception to this. Okay, so why do we pay off the mortgage last? Because think about this: $200,000 to only get $1,200 back. That's little cash flow compared to the mortgage that we're paying, right? Whereas $20,000, or let's do this, $7,000 to get $200 back, right? That's a lot more bang for your buck, which is why we should pay off the credit cards first. Okay, so now let's use our home equity line of credit, and let's go ahead and highlight this as our main operating account. So this will be 20,000, 20, essentially $20,000 credit card. Let's say it's filled up to the max, right? $20,000 balance. What happens when we put our entire paycheck into it? It satisfies the minimum monthly payment, and so essentially that payment doesn't matter anymore. So this goes to zero. Isn't that crazy? And then when we take our expenses out and do the strategy, after every single month, the balance is going to go down by what we call the cash flow. So C2 minus C3. And you notice that just by simply making this our main operating account, let's go ahead and highlight this. We increased our cash flow about $366. Oh my goodness. And we didn't even make more money, right? We didn't even make more money, right? And so now let's go ahead and do this. And what we're going to do is just put our paycheck in, expenses out, and after every single month, our balance is going to go down by $1,500. So now what do? Is we get the next month's balance by take the previous month's balance, previous month's interest, and then minusing by our current cash flow, which is 1535.83. Okay. Now, after every single month, we obviously have to calculate the interest. We take the average daily balance, multiply it by the interest rate, 0.1, 10%, and then divide by 12. That's how you get the monthly interest. Okay. So now what you do is just copy and paste, and then here's the thing, right? Like, I don't think we have to wait until 14 months to get this HELOC down to zero. I would say because these credit cards at a higher interest rate, just when you have the opportunity, transfer as much and still keep this as $20,000 all the time. So I wouldn't normally do this in this scenario, but sometimes it's easier to demonstrate it like this. But what I would do is just keep this HELOC to the brim and then transfer all this debt as much as possible into here. In fact, let's kind of just do this. I'm going to transfer, and here's a tricky part about like credit cards, right? Every time you make a payment, this goes down, right? The monthly payment goes down, so your cash flow slightly increases. So it's not going to always be 1535. It's just an estimate, or it's just kind of a bad poor man simulation of this. But let's just say we're going to transfer $7,000 here plus, and it's not going to be $7,000 at this time either because the balance will have gone down. But that's what makes these a little bit hard to do. Okay, so now at this point, this will go zero. And then what's our cash flow now? 1775, right? You see what I'm saying? 775 point. Yeah, it's just 1775. All right, so now we're going to wait for this to have $10,000 available, right? Okay. And then what we're going to do is move this 10,000. And again, at this point, it's probably going to be like $8,000 or something like that. But let's just be a little bit conservative and a little bit lazy in our calculations. And so now what we do is we got this, and then this is zero. And now we're going to make sure that with our new cash flow, which is 2,100, right, that this will go to zero, right? And so now after 22, about, I'll say, at a max, which is, you know this is a little bit conservative how long it's going to take to pay this off. In less than 2 years, we paid off the two credit cards and the home equity line of credit that we used to the max. Okay, so let me just say, and again, probably like 20 or 19 months. I don't know. But we'll just say 22 months. 22 months to pay off 7, 10, 20, which is 37K. Okay? 22 months to pay off 37K. Now, at this point, you have a decision because, hey, do you still want to use the home equity line of credit? So let's say like we have $2,100 exactly in our savings. Now, do you think most people will dump their entire savings onto the mortgage? It's going to be a little bit hard, and I'll tell you why. Because when you do that, you essentially lose your liquidity. Now, here's the thing. I get that you can dump your entire savings into that mortgage and then use your credit cards as a backup, right? But do you think most people will even do that? Most people kind of be uneasy about that. So that's why I say just use your line of credit as a main tool to prevent something called segregation of income. And I got to make another video about this. But it's the reason why six-figure people are broke. How do I know this? Just Google how many six-figure people are broke. And so, and I've got plenty of people emailing me about their spreadsheets about how they're broke as well. So now, let's go ahead and whether you dump your entire cash or you do, you transfer into the line of credit, it doesn't matter. It doesn't matter because it's going to be mostly the same result. The thing about the line of credit is, yeah, it's going to be a higher interest rate, right? 10%. But, if you transfer pieces of that mortgage into the line of credit, it's mostly going to be the same thing as putting your entire savings in, but it's going to allow you to easily do that, right? I hope that makes sense. And if it doesn't, it's okay. It's very early in the morning for me. All right, but luckily we have this Velocity Banking calculator to figure out how long it's going to take us to pay off this mortgage. So all we got to do is just type it in. And if you don't know about Renatus, this is where I actually first learned Velocity Banking from in 2017. So all I have to do is type it in. And if you ever enroll in Renatus, because I actually sell their courses as a what they call independent contracted market as a third party reseller, you get this calculator for free. All right, so now let's just go ahead and type it in. So let's go ahead and where is this? Now after 22 months, we got to figure out the balance of this loan is. But so what we do is we just go to calculator.net, loan amortization, and then we just fill in the details of whatever. And people say, I go so fast doing this. And the reason I go so fast is because, again, I don't want to stay here all day doing this. And, usually these videos are 15 to 20 minutes long. If I slow down, then it's going to be an hour long. And my suggestion to you is pause the video. You know what I'm saying? All right, so now let's go ahead and figure out what the loan balance is after around 22 months. Again, realistically, it's going to be less than that, but it's going to be 195. So we'll just say this is the balance of the currently the balance of the loan right now. Blah 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 blah. Okay, so now what we got to do is just fill out that information here, and current balance, original balance, interest rate 6, 30 years 1,200, and our monthly income is 5,000. And our expenses, everything except for that income, which is this, or not the loan, which is 1,700, right? So 1,700. All right. So here's what I want to show, right? Here's what I want to emphasize. What you should not do is, especially if you have a higher interest line of credit, is transfer the entire amount, because yes, you'll save money compared to the loan amortization schedule, but you'll pay a lot more money rather compared to, let's say, just putting in money in directly, right, into that loan, or just doing chunking. So let me just show you what I mean. So let's say I have a $150,000 line of credit that I'm transferring this to, right? Take a look at this. The interest is 70 grand. But what if I just transfer pieces of it? They call it incremental payoff, they call it chunking, whatever you want, into that line of credit. And let's say we move 10,000. Take a look at this: 6.8 years and 70 grand interest. Let's just do 10,000. See how that pretty much cuts in half. right? Like that pretty much cuts in half. And so again, uh, m- a lot of people say, "Oh, just move a mortgage into a line of credit." No, you don't want to do that, right? You don't. You definitely don't, unless like somehow you're able to get a line of credit that's at a lower interest rate than the mortgage, which is kind of, I don't think that's possible because that's not how HELOCs or lines of credit are priced, right? They're always going to be priced higher unless there's an exception to like an introductory period, just because you're giving a person two-way access to money or much easier, convenient access to money with a line of credit. Thus, banks will charge more, right? There's a reason why they can charge 30% interest on a credit card because um, the marketplace determines that having really easy access to money is that valuable. Okay. All right. Well, so now this is going to take about 6 years, 6 years. And, well, that's pretty much it. So 6 years. What's 22 divided by 12? All right. 7.83 years to, to pay off everything of 237K of debt, right? So imagine if you were mortgage free, not just mortgage free, entirely debt free, after about 7 years. That would be crazy, right? That would be really crazy. Now, whether, like I said, whether you want to put your savings directly into the mortgage or not, I probably need to make another video. It's mostly going to be the same effect, right? Like, there's nothing special about that line of credit, and again, it has a higher interest rate than the loan, and the interest actually calculate the same amount, the same way, believe it or not. All right. Well, this is it for today. Believe it or not, we're going to actually have um, a live stream later today at 6 p.m. Today's Tuesday, April 30th, about, just an introduction to seller finance notes. So if you ever want to just kind of have a basic introduction to that niche real estate investing, go ahead and click the join button on the YouTube channel. Okay. And you have access to that live stream. So, all right, well, have a great day, everybody, and we will speak next time.